Welcome to authorised TV. Today I'm in Dublin together with Conor O'Mara. Conor is the founder of Three Rock Capital, a discretionary global macro manager here in Dublin. Conor, please introduce yourself and your company.
So I'm the CEO and founder of Three Rock Capital Management. Three Rock is a discretionary global macro manager with an emphasis on foreign exchange. So we trade primarily G10, FX, equity indices, interest rates, and precious metals. So I began my trading career in 1995 at Bank of Ireland, where I was a proprietary FX trader. I left there in 2000 and traded my own account on a full-time basis between then and 2008. I established Three Rock in late 2008, and the firm has an audited track record trading friends and family money since January 2009. We received our regulatory authorization in Europe and the US in January 2013, so we have an audited 6-year track record and have been marketing for 2 years. Our annualized return over the period is 9% net of fees. We returned 8.1% in 2014 and are up 12% at the end of Q1 2015. So a feature of our returns is that they're uncorrelated, so 0.08 with the S&P, for example, over the course of the track record, and less than 0.3 with both macro and CTA indices. So there are 3 principles in the business. We worked together in Bank of Ireland in the 1990s. We know each other for 20 years and each have at least 20 years experience in financial markets.
So Conor, that's an amazing track record for the last 5 years. Tell us in more detail, how did you achieve that? What's special about your strategy?
Our investment strategy is to capture short to medium-term trends. It's a momentum-based strategy and it's 100% discretionary. So our investment process ensures consistency of approach, and there are 2 primary inputs to our investment process: a top-down macro analysis and technical inputs via price charts. So we trade 4 sectors: FX, equity indices, interest rates, and precious metals. And we subject each sector to a macro analysis and a technical analysis with the view to identifying trend potential. That we perceive trend potential in a sector, we'll allocate risk more aggressively towards that sector. And we believe that that's a key strength of ours, the ability to successfully differentiate the sectors with short to medium term trend potential from those that don't have trend potential. For example, in 2015, we've concentrated our risk very heavily towards foreign exchange and to a lesser extent equity indices, particularly those in Europe and Japan. We identified those as sectors with the most trend potential. We haven't traded interest rates or precious metals at all in 2015. A second key strength we believe is money management. So in 2014, for example, our best performing market returned over 5% and our second best returned over 4%, while our worst performing market lost less than 1%. And that relationship over a course of a calendar year is typical and reflects very strong money management. Why am I interested in trends? Well, philosophically, I believe that economies and financial markets aren't particularly well understood from a scientific point of view, for good reason. They're too complex. There are too many variables constantly interacting with each other. And I think the best economists understand that. And you see that they talk very carefully about economies and markets. So given that, I try to allow myself to be led by markets rather than impose my view of what a market should do on the market. So if, for example, a market is trending and I can see a case for why it should, I'll happily go with it. Regarding our performance, I think one reason we've generally outperformed our peers in the last 2 years is that we concentrate our risk. So typically we have 3 or 4 trades in place. Now, if you're concentrating your risk, it's very important that you concentrate it in the right areas, and we've shown a capacity to do that. Now, one question that arises from that is, as we grow, can we concentrate our risk to the same degree? And we don't see constraints in that regard because we trade very liquid markets, generally the most liquid markets in the world. I mentioned that I began trading as a proprietary foreign exchange trader in Bank of Ireland. I left there in 2000, and between 2000 and 2008 I traded my own account on a full-time basis. So during that time I never had more than a modest salary, so I lived on what I took out of the markets, and that breeds a resilience and experience, and allowed me to develop and evolve my investment approach to the point now where I'm very confident that it's very robust. So I've been trading for 20 years, and a lot has happened in that time period if you think about it. I mean, the Asian crisis, the dot-com boom and bust, a commodity bull market, now a commodity bear market, the dollar virtually halving against the euro and the yen and now on its way back up, the financial crisis and its aftermath, the imposition of the Swiss franc and now it's lifting. So, at times very choppy waters, and I would say I've successfully navigated that period. And the primary reason for that, in my opinion, is money management, is strong money management. There are two sides to money management. There's downside management and upside management. So on the downside, we're very aggressive. I've never had a high pain threshold. So if a trade isn't working, I'll get out quickly. So as soon as a trade goes on, we put a stop loss in place, so we always know what our worst case scenario is. On the upside, we're much more comfortable running upside than downside. So, for example, in 2014, our best performing market returned over 5% and our second best over 4%, and our worst performing market lost 1%. So that relationship is typical over the course of a track record, and is a good illustration of our money management.
So Conor, even investors today say that the current environment and also the next years will be very fruitful for global macro and FX traders. What's your view on what's coming for you in this strategy?
As a manager whose strategy is to capture trends, and with an emphasis on FX, the environment in the last 6 months has been very fertile for us. So we returned 31% since last September, over 24% in FX. So looking forward, we think that the FX environment will be very productive for the next 3 to 5 years, and we think we're in a good position to take advantage of that. So we think that a dollar bull market, a secular dollar bull market, is underway, and as that plays out, there will be prolonged periods of trending environments which will suit us. And in the very short term, we think that the initial phase of the dollar bull market has probably ended, as the Fed has indicated some resistance to dollar strength. So we anticipate that the dollar might consolidate for a number of weeks or a small number of months. But ultimately, we believe that the primary trend will reassert itself as the divergence between US policy and that of other developed economies drives things. In other sectors, we continue to like equity indices, particularly where the underlying currency has been devalued. That said, in the very short term, we see evidence of a correction developing. And in the last couple of days, we've cut our equity risk right back. And overall in our portfolio, we don't have a lot of risk on now. We've cut right back in the last 2 weeks.
Conor, tell us more about your structure. How can people invest with you?
So Matthias, we offer managed accounts, which give an investor transparency and daily liquidity. Our fee structure is 0 and 20. We're not charging a management fee for any new accounts opened in 2015. And our margin to equity ratio has averaged 7% over the course of the track record and won't be above 15%. So that provides an efficient use of capital for an investor.
So Conor, that was really interesting. Summing up now, please tell us, what do you think are your key strengths and how are you different from other discretionary managers?
Well, we would say a key strength is that we've shown a capacity to generate absolute returns in different market environments. In terms of differentiators, our FX focus is a differentiator. Typically, half of our risk is in foreign exchange. We're low cost. We're not charging a management fee. Our returns have been consistently in the top quartile of our peer group and uncorrelated. So I suppose, Matthias, if I was to leave with one simple message, it would be that we believe the FX environment will continue to be very productive for the next 3 to 5 years, and that 3 Rock is in a strong position to take advantage of that.